Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focused Compounding, sitting next to the co-founder, Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else as well. If this is the first time you're tuning in, be sure to check all of our content, 250 plus episodes. And you can get access to that through wherever podcasts are normally listened to. So iOS, Spotify, Amazon, we're on YouTube, all sorts of different outlets. So be sure to check it out and you'll find all of our content. I think we either passed or we're coming up to our 3-year anniversary of the podcast.
Oh,
I was thinking about that the other day. So I got to check to see the exact date, but I'm pretty sure it was in January.
Okay.
So we're right there. So anyways, just keeps getting better with time, Jeffrey. We're going to be talking about today Tenneco, which this is the stock that a lot of people love to reference when they talk about Charlie Munger. So back in 2017, I was very lucky to be at the Daily Journal meeting in California.
Yeah.
At this time, there probably was maybe less than 100 people there. Now it's like a huge, thing. Like I saw in 2018, they had to even get a bigger venue, and then 2019, a bigger venue. But I was there in 2017. It was awesome. And afterwards, Munger sat there and was just basically answering questions by a group of us that stayed after just to kind of hang out. And one thing that I always think about, and I was telling you this last time, when I think about this meeting, was probably about an hour to maybe an hour and a half after the meeting was over and he was sitting there just answering questions from everybody. Somebody came up to him, I'm assuming his driver or somebody that was just part of his, his personal team, I guess you could say, and said, "Charlie, it's time to go if you want." And Munger was like, "No, let's stay. There's people that have come from so far." And, he was referring to the people that flew there from China to listen to him speak. So he stayed, he answered questions. It was awesome. I'll personally never forget it. And there's a quote that he said, or something that he said from this Q&A session afterwards that has been circulated widely on Twitter, publications. People always love to talk about it. And it was when he talked about Barron's. And he said, "I read Barron's for 50 years. In 50 years, I found one investment opportunity in Barron's, out of which I made about 80 million for almost no risk. I took the 80 million and gave it to Li Lu, who turned it into 400 million or 500 million. That's how you know you're really wealthy, when you're like, 400 or 500 million. So I have made 400 million or 500 million out of reading Barron's for 50 years and following one idea. I didn't have a lot of ideas. I didn't find them easily, but I did pounce on one." And that was the quote from the Daily Journal meeting. And the company that he pounced on was Tenneco. And we're going to talk about it today. So from doing some research around it, I was trying to gather the facts, and we're going to pull up the financials and just really see if we could reverse engineer and see if we could, learn anything from it, and whatever we could take away. And because of QuickFS, we could pull up 20-year financials. So we could go back to 2000, 2001, 2002, the time frame when he was looking at it. So he bought the stock around $1.50 to $2 per share, from what I could find from checking a bunch of different resources. And he also bought bonds, 11% notes yielding 35% to maturity.
Right. Okay.
So he bought.
They were 11% when issued.
Yeah,
but they were 35.
Correct. So I wonder if part of the thought process was if the equity gets wiped out, at least my bonds can maybe get converted into equity.
Could be,
as a way to hedge that margin of safety.
But collecting the 35% a year isn't bad either.
Facts, absolutely true. So within a few years, the stock went up to $15. At one point, at the point that Munger sold, the bonds went back up to par value and were called in by the company in conjunction with the refinancing. All in all, the 10 million that he originally invested, it says he made 80 million, and then he parlayed that investment into Li Lu's fund. Just to get a little bit of a background on the whole situation, let's see. So Tenneco had a history of consistent profits, but faced headwinds in the late 90s. Shares had fallen from over $10 a share to under $2 a share, which is the point at when he started looking at it. Tenneco had 40 million shares outstanding, a market cap of 80 million, and an enterprise value of 1.6 billion. Total debt was 1.5 billion.
Yeah.
By 2002, the operating income had improved from losses of 130 million in 2001 to profits of 31 million in 2002. But during this process, so I guess GAAP profits were really skewed to DNA because cash flow from operations was very positive during this time.
Okay.
And I think his, mindset going into it was basically that they were going to deleverage and that the equity would move up. So as you can see right here, if you're looking at the screen, he probably bought it, it looks like in 2000 to 2001, this area down here, and then he sold it around $15 per share. So pretty crazy, great trade. He loves to talk about it.
Twice, right? You would have gotten three
Looks like,
times.
it could be a third time, right?
3 times it's been at that same price, and 3 times it's been at those same highs.
Yeah.
So,
yeah. Very interesting, isn't it? So we could
that's a
pull
volatile
up
stock, yeah.
Yeah, and we could pull up. Let's see. I mean, I thought it was interesting that he bought the bonds as well.
Although that could be in part because of the size of the market cap. There wasn't enough common stock available compared to what he wanted to buy.
I was thinking about this too. I'm like, some of these opportunities, he always talks about the way you get wealthy is by having $10 million in a checking account and pouncing when the opportunity comes. And I was thinking about that. I was like, gosh, okay, what if you had 10 million, but it was so illiquid, or you just, there wasn't enough shares to buy or something like that? How would you?
There's a lot more bonds, we just said. So if you do the math on the bonds, at face value, what do we say? There was 1.5 billion, but then it's still a lot of bonds. There's probably 10 times more market value in bonds than there was in stock or something, depending on how long it was till they could be called.
Absolutely. So we could pull up, we could go into their 10K, or I did pull the financials from QuickFS as well. I thought it'd be kind of fun to look at it. So if you're looking at the screen right now, and I'll try talking through it for people listening on the podcast, but yeah, 2000 and 2001, let's see, the market cap was down to, 2000, it was 109 million market cap, and then it down to 82 million in 2001. And you could see right there, it was on a GAAP basis, very negative. But I guess we could go over to the cash flow statement and look. In 2000, they still generate 234 million in cash. In 2001, 141 million, and then they never actually burned operating cash flow, which I thought was pretty interesting.
Right. Yeah, and for an established company, that's normal. For a lot of the companies we see today, right, when you have startups and things like that, you see negative cash flow from operations, but it's something you always want to see positive cash flow from operations. It's one of the first things we look for.
Yeah, and this was an auto part manufacturer as well, is what I should say. That had a successful, 90s, and then ran into some issues.
That, yeah. Especially if they're based a lot on providing for the Detroit manufacturers.
I wonder how much of this too was part of the times. So this is when the tech bubble was happening. So nobody cared about anything, any sort of manufacturing companies or anything like that. It was all technology stocks. Kind of like
also there was tight credit. I mean, what was the year that he bought? What do we know about the exact date? Because we just read the market cap as of the beginning of end of 2001.
Yeah.
So right around then, the very end of 2001, after a few months after September 11th, there would have been a lot of junk bonds available and stuff. That would have been there would have been a lot of high yield stuff. So it's, we don't remember as much of a recession or anything, but did have a lot of opportunities for high yield bonds at that time.
Yeah, it was, from what I could find from different sources, it said that he bought it for $1.50 to $2 per share. So call it maybe 2001 area. So I thought that was interesting, and I thought it was kind of cool to take a look at. Do you think this is ever a situation where you would feel comfortable going into it, or do you think the debt would automatically kind of scare you away? We look at companies all the time that the EV is, sometimes way more than the market cap because they're carrying so much debt. It's like, how do you handicap that situation? Is this really, the company's plan was to deleverage so you could feel more comfortable that the equity wouldn't get wiped out and would move up once they did that?
He did this 100% with his own money, right?
Yeah.
Yeah. I could see you doing something, I don't know this exact thing, but something with my own money that no one else ever knows about. Now people found out about him doing this, in something like that. But I think it'd be different in a fund or something like that. So if we look to get some ideas on because it really depends on the cost stuff. So can we go to ratios?
Yeah, sure.
Because they have ratios, I believe, going back to the beginning, right? Or as far back as the ratios
2000,
go.
Correct.
Okay, so that will help us here. So if we go down to the ratios, the important things are, we don't have a lot of price ratios for this, actually. Do they?
Yeah, we have price earning, valuations and stuff.
Okay, what valuation was
in the 2000, 2001, 2002, PE was negative, but price
Right.
to sales 0.03, 0.02, and 0.05 from 2000 to 2002.
Right, but then you have the leverage coming in. So it's fairly cheap on an EV basis if I just did that right. So what were the margins like generally?
Gross margins in the 21.6%,
Yeah.
19.8%, 20.9%.
I don't know. I mean, there are some features of this that look so. If you go to QuickFS and look, which you can do at your own time and everything, take as long as you want to look at it. There are some features, even if you go back there to when he was making this investment, that if the period before then looked like I suspect it did in the 90s and stuff, then you would have thought that this company would continue to operate fairly consistently. However, it might be in real need of recapitalization, right? Mm-hmm. But we've talked about recapitalization before. So let's say even if you thought, like we talked about with movie theaters, right? Mm. If you could get the lowest price that there had been on some of those stocks, or actually the one we really talked about, I think, was Dave & Buster's, that in a sense, if you can figure out things about it, it's going to survive and will be able to access capital. It may not be that important because even if you're diluted down by half or by 3/4, it could still be a bargain. In other words, like even if there'd have to be a probability. The most likely situations you get diluted by a lot. And that's definitely the case. I mean, with what you were saying with the price to sales being as low as it was. Just because this is very, very cheap for a company that's like consistently making some money, just like we talked about from cash flow from operations, operating income, the things that are pre-capex, but also pre-payment on interest, right? Now, he found it in Barron's in an article, I assume, about it.
Yeah.
And then I assume there would have been more context about what they were doing. So if he knew that they were intending to pay down debt or refinance and all of those sorts of things, then that could have been helpful. The other thing is, like I said, it may have been specific. We have a chart, right?
Yeah.
It may have been specific to the time period. So if we look at the chart, see, what might have happened is that the deterioration in the stock price became more rapid at some point than the deterioration in the business. So this happens a lot with over-leveraged businesses. For a while, like the business is probably over-leveraged in many of those years we see on the left-hand side of the chart. But no one's concerned about it because they're doing okay. They're able to refinance everything. Once you are a very leveraged business and then it becomes difficult, either your business gets worse and so people are worried about you being able to borrow and stuff like that, or it becomes an environment where it's hard to borrow, then you suddenly have really rapid deterioration in the stock price. And we see that with the huge stock price drops in the stock each time. It's probably exacerbated by debt. Mm-hmm. And I don't just mean that it has a lot of debt. So the EV is moving. So the market price is moving by an appropriate amount for small changes in the EV. I actually mean that people are like responding mostly to it as whether or not it'll go into bankruptcy. If we look there, I'd say that's a pretty rapid drop there. And when is that? Is that in 2000? What year am I looking at?
Yeah, this is 2000. Like
that
right here. 2000, 2001's right over here.
Yeah. So like he may have bought it after it had descended for quite a long time, but there's an extremely rapid drop before there that would be hard to see in the deterioration of the financials. So it's extreme that way. We don't have the multiples for before it, but what would have happened is the multiples contracted from something normal looking to something totally abnormal. Mm-hmm. We can look at the balance sheet and things like that, right? We have the balance sheet from back then, so you can get some idea. So we have the balance sheet for 2000, 2001.
Yeah, it's right here. These two.
So what do we have for things like total liabilities and?
So total assets 2.8 billion, total liabilities 2.5 billion. And this is 2000. Let's see. And then total shareholder equity 344 million, but total liabilities and obviously it was 2.8 billion.
Okay, so we could just go over some of the things I would look at. Like I was looking at some companies this past week that I expect to file for bankruptcy within the next few months or something. So we'll look at this and see whether we think that kind of thing is present. I don't know that they will. In the past, they were able to raise capital. So if things keep going well, they can again. But in other words, look and see if we think this company needs to raise capital. So we start with the liabilities. And then we ask questions like how big are those liabilities and stuff, and in what form are they? So the most important thing is just what's the total liabilities, and then compare that pretty quickly to the cash and to current assets. And we also compare debt. What form are their liabilities in?
So they have 1.4 billion. This is in 2000. So they had total liabilities of 2.5 billion. Of that, 1.4 billion was long-term debt, and it looks like 92 million was short-term debt.
Okay, so they have 1.5.
Yeah. And then they had cash at the time of 35 million. But total current assets was 1.1 billion. So about 487 million in receivables.
Right. And what were their current liabilities?
Current liabilities, 809 million.
Okay. So they do actually, I don't know which date it was as of that he bought it that year or the next. But they did have actually some excess of current assets over current liabilities. Which is interesting, but total liabilities exceeding current assets because of the amount of debt. So it's a question of refinancing the debt. And then you look at things like like we said, the cash flow statement. And actually, does the income statement show EBITDA on this one? Because maybe that's what people care more about here.
Yeah, it does.
Okay.
So it generated in 2,266 million in EBITDA.
Right. And they had their EV was like 1.6 billion. So there you go. You're about, 5 to 6 times or something like that. Yeah. So, price EV to EBITDA 5 to 6 times. It's not, there's things that are cheaper. So that's one of the interesting parts about that.
I mean, when you're looking at those companies that you just referenced that you suspect will go into bankruptcy unless they raise capital, I mean, what are you looking at? So maybe like in this situation, if you were looking at it with a fresh pair of eyes like you were with those other companies, I mean, what are you trying to handicap? What are you thinking about?
So biggest issues is very low levels of cash, then very low levels of current assets, very high levels of liabilities, failure to generate cash flow from operations. So there's a couple of them, and they've been public on a listed exchange and stuff for over 10 years, in which they've never generated positive cash flow from operations. And so their cash burn in different cases is different amounts of time, but in one case it's probably less than 3 months, in another like a year. Given that they have so little cash on hand, and they don't generate cash flow from operations, it actually sucks up cash. They need to put more money into the business to do that. And so it isn't a problem of generating cash, but then you have a lot of liabilities, which is something to work with. This is interesting, this stock, because in some ways it's probably a normal value stock, but the leverage inherent in it is so big. Because all the upside is in the equity, right? Or actually, there's a lot of upside in the bonds too, because the bonds happen to also be trading very cheap. So as it turned out, I shouldn't say that. I mean, for equity investors, a lot of times we assume that the price that we see for debt is the amount that you would actually be able to buy it for. But in reality, sometimes just like the stock, it's at way below par, which is the case here. So you could buy either one. So if we actually, that's the part I don't understand from this, is the yield to maturity thing. So when they do the calculation, you do a calculation on yield to worst because he was being called in a couple of years or whatever from this. So the question would be, how long was that? If we knew exactly how long it was till the bonds were called, and he knew that they could be called then we could figure out from that thing that they said about yield to maturity thing, which if we assume that that's not exactly what they meant, that they meant yield to worst, that we could figure out how cheap they were. It's very possible the bonds were also something that could return like 3 times or something, It depends. But if the bonds were able to be called very soon and you still were going to get a really high return, then it's not necessarily the case that the stock was a much better investment than the bonds here. So the bonds might have also been very, very cheap. So the enterprise value I'm calculating, you know how we do enterprise value calculations all the time? So I'm saying the enterprise value was 5 or 6 times. That's true if the bonds were trading at par, but we know they weren't. So if the bonds were trading at a third of par, okay, then it's 2 times enterprise value. It's very cheap, and you should buy the bonds. You could buy the stock too if you want. And he probably bought as much stock as he could, but also as much bonds as he could.
Yeah, so he bought it, I think it was 2001 area, and then he sold it in late 2004. And the stock, at least from what we have here, went from just, and it goes by the dates, like when they pull the data, 82 million market cap to call it 740 million in market capitalization. Do you think in this situation it really would be trying to understand the narrative too? Like, are they going to deleverage, and is the business going to be able to do that without having to, I guess you could say, like reorganize or wipe the equity out or anything like that, recapitalize?
Maybe, but if he was buying the bonds, then he'd be participating in that either way. I think a lot of it hinges on how cheap the bonds were, because the other thing is, if the bonds were really that cheap, a few things could happen. One, you could buy the bonds, so you don't even have to buy the stock. You could buy the bonds, you'd get a good return. Even if things went wrong, you might be somewhat better protected. We don't know a lot of details about the bonds. But the other thing is, let's say that things could get reorganized or whatever, that more money could be put into it, right? So you sell off a division and you get cash for it. Well, then you can turn around and you buy your bonds, right? So you could retire $1,000 worth of bonds for what, $300, $400? I don't know what it was at the time, but you could do a lot of things that would reduce how much you have to pay in the future. And we know from looking at the business itself on an operating basis is fine. I mean, that continued to be the case. But from what I can tell, for the next 20 years, actually, the stock continued to be very similar. Not a lot changed. In that I'm sure they acquired a lot of things and stuff, but it continued to have the same issue, which is that for a long time, it would have looked like a fairly predictable, if it hadn't carried any debt and stuff, sort of business in terms of operations. But there would have always been this issue of what about the financing of it, Because even if you compare things like free cash flow versus cash flow from operations stuff, you can see some issues sometimes from that about how much they have to use to pay down stuff. Because see, like the free cash flow looks good in some years, but if you think about it, how much debt they originally had out, they sometimes have 5 or 6 or more years of debt out in terms of free cash flow. So this is a pretty traditional business that way, in that it is over leveraged probably, or it's very leveraged, and it has a lot of, the operations are fine for the most part. Because we're looking at a cash basis, which is really how you have to look at this. And there's a fairly high degree of consistency in that very rarely, I mean, we're not seeing any numbers, and this is after Charlie bought in. So, but even after that, which wasn't a good time period for the industry and stuff, you don't have years that are very bad in terms of cash flow from operations. So it's not that operationally challenging to finance the business. I mean, to me, it's very hard to analyze because I need to know more about the bonds. But if you knew more about the price of the bonds, because like I said, from the article thing that you read back to me, the problem with that is I don't know what that means. If they really meant to yield to maturity and stuff, I don't know what that means. But if they was trading at a very deep discount, the bonds, then the entire enterprise value of the company was very cheap. And then you could definitely buy on that basis. I'd have no problem doing that.
Have you ever invested in a company that had a lot of leverage?
Yes. I mean, I've invested in financial companies with lots of leverage, obviously, but I've also invested in companies, that had lots of leverage.
Where are we here?
And it usually hasn't gone well.
No?
I'm trying to think. In what cases?
Operating leverage or financial leverage?
Financial leverage. I'm trying to think of cases where it's gone well, where I've invested in a company with a lot of leverage. I can't really think of any.
I'm having a hard time scrolling through for this cash flow statement here. I just wonder if there's any takeaways you could have from the situation. So is it when you have a business that you always generates cash, and you're looking at it from a cash basis, and they do have leverage, but the business itself is actually predictable, and management sounds like they're going to deleverage?
Well, if you have a business with a very long history that's fairly predictable on a cash basis, and then it's very cheap on an enterprise value basis, then it's usually going to work out, I would say, if you buy into it. It works out better than people think. The problems are, I would say operational issues are harder to solve than financial issues. So if you were really interested in doing debt stuff, whatever, I do think that historically it made more sense to be interested in like reorganization of a supermarket, reorganization of a railroad. Because those things, and what the business we're looking at here, were generative of cash without the interest payments and the debt repayments consistently year after year and everything. If you have a bit more of a problem if you're talking about a tech company or something. Those are the kinds of things where you can have bankruptcies that are very different. And then it's just an enterprise value issue. How cheap was it on enterprise value? My guess here is that it was incredibly cheap. But I think the biggest problem here is doing the calculation that it doesn't look that cheap because we're using the face value of the debt and the debt was nowhere near the face value. I think the biggest lesson there is to figure out what the actual price the debt's trading at. And they will mention that sometimes on things like Value Investors Club and stuff, and you have professional investors who look up bond prices. But I've often read things where it's assumed that the debt should be calculated for enterprise value as if it's at face value, when in fact it's nowhere near par. Yeah. It's nowhere near where it was issued. I mean, if the stock is down 90%, it's not a surprise that the debt isn't trading at 100 cents on the dollar, you know?
Yeah.
But stock investors always use yesterday's stock price, but not whatever the debt happened to be. And like I said, there's things you could buy back. Debt, I mean, there's lots of different things that could be in your favor. And the most is what he did. He bought the debt.
Mm-hmm. Yeah. I just wonder, I mean, the funny thing is so he took that and he parlayed it into Lee Lu's fund, but he read Barron's for 50 years. And this was the idea that he bet big on and he pounced on. And I just find that the most fascinating part. I mean, what's that hit rate over, 50 years of Barron's? I mean, Barron's comes out once a weekend. I mean, it's like nothing.
Yeah. It gives you a good idea because it's like whatever.
1 in 20 plus thousand or something like that.
Yeah, it's a lot. So I think the one that's noticeable for it is compared to like Buffett and stuff, it definitely has a focus on the upside. So probably why Munger passed on most things is that there isn't as big an upside. That's why he acts so
where he like
because he has a really, really big upside.
He viewed it as like massive asymmetry.
I get that would be true. I think that's very different from Buffett. Yeah. So I think that he saw it as having a very big upside that way, yeah. But it's also interesting he also bought the bonds. Mm-hmm. So, I mean, you could say, he's buying the stock because he's trying to use the leverage on it just like in an option or something, But that's not really true because he was also buying the bond, which defeats the purpose of, buying the stock.
Yeah, I wonder if he did that just in case the equity did get wiped out. And maybe just like you said, that's just what he could buy too, buy a lot of it.
Yeah, but if you think about it, depending on how cheap those bonds were, even if the equity didn't... the enterprise value, the EV was very, very low. Mm-hmm. So it might have worked out in any way, to be honest. It might have worked out if you got paid off on the bonds, but it also could have just worked out in the sense that if he was able to buy up everything, stock and bond, if you imagine that you could buy the entire enterprise value of the company, it may have been very cheap. I don't know because I don't have the historical bond prices.
Got it. Yeah, it would be very interesting to hear him talk a little bit more about this situation and what he thought about it. But yeah, from what I've read from a few different sources, it was very much that he didn't think the business was going to have to restructure. It was generating cash and they were going to deleverage. So he felt very comfortable that the equity would get moved up. But like you said too, it is very interesting that he bet pretty big on the bonds and everything. And I wonder how much of that is liquidity, how much of that is because he just wanted to buy everything he absolutely could, or because they're trading at a massive discount or what. But nonetheless, it's very interesting to look at. And he made a ton of money. But the most interesting thing from it, takeaway wise for me, is the waiting for the big idea and pouncing. He does talk about it like it's so simple too. He's like, we own, what did he say, like 3 stocks: Berkshire Hathaway, Lee Lu's fund, Costco.
Right.
And he's like, it doesn't need to get more complicated than that. Mm-hmm. Now, you could look at Lee Lu's fund as a conglomerate of some sort. You could look at Berkshire Hathaway for what it is, a conglomerate, and then there's Costco. But it's the punch card way of thinking about it that you really sit there and wait until you have the opportunity, and you probably only do get 3 to 4 big ideas in your life. And he said that was something that was very instilled in him from a very young age.
Okay.
His grandpa would talk about that a lot with him. So he said from a very young age, his grandpa was a judge. He knew that you only get a handful of opportunities and you have to really seize them. So that's the most important thing to me. And the biggest takeaway from this is just the willingness to turn over rocks and be okay with having a very low hit rate. And then when you pounce hard.
Yep.
Very fascinating. Very fascinating. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focus Compounding Podcast. If you want to support the podcast, you do it very easily by giving us 5 stars on iTunes and leaving us a rating review. If you're watching us on YouTube, hit that subscribe button, thumbs this video up. Let's hack that algorithm. We appreciate all the support, and we will see you in the next podcast.